In this video, we're looking at the one comprehensive problem you need to do for chapter 17. This pretty much encompasses everything you need to know for the whole chapter. Now, this looks like a really long problem if I scroll down through it, but you really don't have to put in a whole lot. You don't have to do a whole lot in terms of what you need to actually do to this spreadsheet. However, it will take some time to understand what's going on here. So I might need to make more than one video, but just be patient. And even though you don't have to know everything that I'm going to go over in order to actually find the answer down here at the bottom, it's important that you understand why we're doing what we're doing and how all this sort of plays out. The kind of challenging thing about this problem is we're actually talking about two purchases. And it's a little bit confusing the way they have it worded. I actually believe the years in the book are wrong. I think that I had to change this in order to get this to make sense. But anyway, let's just start and work through it from the beginning. So we have a chemical company that has purchased new equipment for $40,000 at the end of 2013. Okay, so at the end of 2013, they purchased $40,000 worth of new equipment. So we'll put that right there, 000. Okay, now the equipment has an expected life of 4 years and was classified in the 3-year class. So I've got those percentages of depreciation right here, and I've actually put them in these cells right here. So we know that, okay, now we know that they're going to, or they're thinking about replacing this. Now they're calling it old. See, it's called new up here, but then in 2 years we're going to start calling it old, right? So this is what's confusing about the way this problem is worded. The new equipment here is the same equipment as what they're calling old down here. So anyway, so the company is considering replacing this equipment with a more efficient process line at the end of 2015. So we're talking about a 2-year time span here. And the salvage value of the old equipment that they bought at the end of 2013 is going to be $4,000. So we're going to put that in for the resale value right here. And the marginal tax rate is 40%, so we're going to put that right here. Now we're going to come back. Actually, I can jump, not 4,000%, 40%. Let's change that. Okay, now the discount rate that we put in here doesn't actually come to play until later, but let's just scroll down and see what it is so we can go ahead and put that in now. Now, it's right here, okay? So the cost of capital for the company is 6%. So let's go ahead and put the discount rate in here. So we just have that. 6, hopefully that'll be 6. Nope, 600, so it's there. Now it's 6. Okay, so now we want to calculate the cash flow from the sale of this equipment. Assume this sale occurred at the end of 2015. Okay, so if we look, so the first thing we want to do here is we want to calculate the depreciation. So I've got the formulas in here that just simply multiply the cost right here, 40,000, by the year 1 here and year 2 percentages. So you see this is going to be higher in 2015 because 45.5% is higher than 33.3%. Okay. Then we just simply add those two up and put it here. and I've got the formula for that. And then we want to put in the book value of the old equipment, and I believe we're given that somewhere. No, we're not. Sorry. This is the price that we paid right here, 40,000 minus the total accumulated depreciation. So that's going to give us our book value. Then the resale value we got from up here. That was given right here. So we put this in. Now, since the book value is over double what we're actually going to be able to sell it for, then this is a loss. Then we're going to take a loss on when we sell the old equipment of $4,880. So that goes in as a negative, as a loss. And what that means is we're going to be able to take this off of our taxable income. So since we can take this loss, we can subtract that off of our taxable income. That's going to give us a refund of 40% of this loss. So that's going to go right here, 40%, because our tax rate is 40%. So that's going to give us a positive. And then the net of all this is going to give us a net cash received for the old equipment of $5,952. Okay. So that takes care of part A. Now, we're going to get to the new process line in part B, which is expected to boost sales. So as a result, the cash requirement will increase by 1,000. So we're going to have we're going to have an increase in our current assets, and the cash increase is 1,000. And our accounts receivable are going to increase by 5,000, so we'll put that right there. And our inventory is going to increase by, where is it? 10,000. So put that in right there. And that's going to give us a total of 16,000. Now we also are going to have an expected increase in current liabilities, and so we have to put that in. So that's going to be our accrued expenses are going to increase by 3,000. I think I skipped something here, so let's go back. And then our accounts payable are going to increase by 6,000. What did I say? This should be a 3, right? And this should be 6. Okay, got that right. Okay, now we know from chapter 4, I believe, that total assets have to equal total liabilities plus common stock equity. So if we're going to increase our current assets by 16,000, and we're only going to increase our current liabilities by 9, that's going to give us a need of additional working capital of $7,000, because these have to be equal. I mean, we have to change these, either these have to, if they're going to increase, they need to increase equally in order for this to hold true. So we're going to need to borrow an additional $7,000 in working capital. And just to make this easier to understand, let's just say that that's what we're going to need to use in order to increase our inventory here. So we'll just assume that they're going to use this in order to have the cash needed to increase their inventory by $10,000 worth of a new inventory. Okay, so that's that. Now this is important because we're going to come back to this later in the problem, and I wanted you to understand what's happening here. So we're actually borrowing $7,000 more dollars, which is going to add to our liabilities and make our increase in current liabilities equal to our increase in current assets. Okay. Now, let's see part C. So, the new equipment. Now, the new, right? This new process line is going to cost $180,000, and that includes installation and startup cost. Whoa, so we're going to put that right here. $180,000. And we also have to add in our additional net working capital that we had to borrow, and then we get to subtract out the proceeds we got up here from selling our old equipment. So that's a net positive, but we're actually going to subtract that out in order to get our net cash outflow. So we're subtracting this cash proceeds because this comes out of what we're having to pay out initially to install this new process line. So the net cash outflow is going to be 181. So we're adding up the 180,000 and the 7,000, and we're subtracting our what we got from selling the old equipment, and we're come up with an initial net cash outflow at the end of the year here, right? When we're going to buy this new equipment, and it's going to be installed at the end of 2015, and that's going to be $181,048. Okay, so that's so far so good. Now, the next thing is we're going to look at cash flows that are going to be generated by installing this new process line. And the cash flows are going to be $60,000 for 6 years. So I'm going to put that in here, $60,000. I'm probably going to run out of time because I only have 15 minutes on one video. So if I run out of time, we'll just pick this up. 60,000, right? So let me take 1 0 out of there. And 60000 and 6. So for 4 years, the cash flows are 60,000. And we also are going to reduce. We're going to reduce because this new process line is more efficient. We're going to reduce operating expenses by 6,000. So that's going to be added in there as well, because when you reduce a cost, that actually creates a positive cash flow. So we're going to go 6,000 here, and 6,000. Whoops, 6,000 here, 6,000 here, and 6,000 here. Okay. Now I'm going to actually stop this because I don't want to finish and then run out of. I don't want to run out of time right in the middle of finishing. So I'm going to stop here, and we're going to pick this up on the next video.